Hello everyone, hi, I welcome you all of you to the channel of Wall Street Mojo. Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic with us is General Journal. Okay, as the name itself, the General Journal is an initial, or it's called the journal entries. Let's make this simple. The journal entries is an initial record, keeping which records all the transaction except for the ones which are recorded a specific specialty journal, like cash journal. We have purchase journal. So whenever an event occurs or a transaction happen, it is recorded in a journal, and journal can be divided into two types: specialty journal and general journal. These are the two types. So a specialty journal records all the sort of, I can call this, special events, transaction that are related to that particular journal. And there are mainly four kind of specialty journal. One is called the sales, another is called the cash receipts. Okay, then there is a thing called purchase journal, cash disbursement journal. Okay, these are the four types. Now, the company can have more specialty journal depending on its needs and the type of the transaction. But the above over here, four that have been mentioned, contains the bulk of the accounting activities, and all of the transactions which are not entered into the specialty journals are accounted in the general journal. So this can have the following types of transaction, like account receivables, accounts payables, which this is known as your debtors, this is your creditors. Then we have a thing called equipment. We have the accumulated depreciation. We have expenses, interest income. It also includes expenses. Okay, now we'll try and discuss the general journal accounting part. Okay, the double entry book keeping is the most common method of, let me just write, double entry bookkeeping system is the most common method of general journal accounting. Now, this is the most common method of accounting. Every business is done by exchange between, the transaction is done by exchange between two accounts. So there are equal, what we call as opposite accounts for all the transaction. Namely, there can be credit and debits, both are possible. Hence, when a transaction is recorded in a journal, it debits one account and it credits another one. Okay, so for example, let's say if a company, let's say it purchases of $5,000 of inventory. Now, using the cash and inventory in the journal would be made whereby cash account is decreased. The cash account is decreased, let's say, by 5,000, and the inventory will be increased by 5,000 here. Okay, now I will provide you with the format part of the journal, the general journal format. It provides the chronological order of all non-specialized act, consists of 4 or closely 5 columns. Now the first one starts with date of transaction, then there is a short description. They also goes with memo. Then there is debit amount. Then there is a credit amount. Post facto, there is a reference number, and the referencing to the journal ledger is a very easy indicator. Okay, remember that. Now let's take an example over here. Let's look at few examples. Let's say you purchased an asset, okay, and that asset, you purchased that asset by cash, and let's say that is machinery, and you purchased it by cash. So machinery account is debited, cash account is credited to the extent of, let's say you purchased the machinery for $1 lakh. So this will be debited because machine is coming in your company. Cash you are paying and that is going out, so it will be credited. Debit what comes in, credit what goes out. Now let's say you incur some expenses, let's say selling and distribution expenses that you do. Expense debit and income credit. Let's say you are doing this expense by cash and it is $5,000. So 5,000 debit over here and 5,000 cash is going as credit. Let's say now take up for an income. Let's say you're receiving an income. So cash is coming in and the income is the interest income. So interest income account credit, because debit the expense, credit the income. I'll take the same amount here. We took one of asset. Now let's take one of liability. Well, let's say you purchase that same machinery, but not with cash, but with the help of liability. Let's say you purchased on credit. So creditors will open up. Let's say you purchased from Glenn Smith and and that was of 1 lakh. So the above entry now converts to, instead of cash, there's a liability that is standing. So these are a couple of examples that you need to understand, so that you have a great idea about exactly what's going on. Now the flow of the process of the journal entries. Now let's look at the flow of the process of journal entries before and after it is recorded in the journal accounting. Now before an entry is made in journal entries, maker has to decide accounts which will be affected by the transaction, and second, which accounts to debit and which to credit. Now, after these entries are properly made in the journal, in the accounting, all this transaction is summarized, right? And it is posted in ledger. Now, a ledger over here is an account of the final end, which is a master account. It is the master account that summarizes the transaction in the company, and it has individual accounts that records your assets, your liabilities, equity, includes your equity, then your revenues, you have expenses, gains and losses. Now some example of accounts are in the ledger are account receivables, accounts payable. So this is your asset, this is your liability. Then you have your retained earnings, which is your equity liability, equity account. Then let's say you do product sales, so that goes with your revenue. Just taking one example of all. Let's say cost of goods sold, so that goes as expense. So to summarize, every accounting transaction is stored in a journal, which acts as an intermediary repository of the information, which is then recorded in the general journal ledger. So the ledger in turn is used to aggregate this information into the financial statement of a business, which are called as the initial trial balance. Okay, so let me make my final conclusion on this. The general journal is initial record keeping, which records all the transactions except for the ones which are recorded in this specialty journal, like cash purchase journal, and it states that the date of the transaction, the description, credit, debit information in the double bookkeeping system, and the journal entries are then used to form a ledger, and the information is transferred into the respective accounts of the ledger. The ledgers are then used to make trial balance and finally the financial statements. However, these journals were more visible in their manual record keeping days. So with the advent of the technology, the task of record keeping has been made very easy, with all the information being stored in a single repository with no specialty journals in use. So that's it for this particular topic. If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.